sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I believe each and every one of us has a right to proper financial planning, whether it's an estate plan, college plan, tax plan, retirement plan. I am joined today with Andrew Mullane to talk about your financial plan. Andrew is 24 years in the financial services business, a financial advisor. He's a partner in Omnia Financial. He's based out in Long Island. His partner, Brian, is in New Jersey. They're very good friends of mine. Andrew is also a certified financial planner. And I thought I would invite him on the show today to talk to you guys specifically about risk management, portfolio risk management, surrounded around asset allocation. Andrew, welcome to the show. Let's kick it off. How do you describe with your clients risk?
All right. Well, Bruce, thanks for having me. I appreciate it.
My pleasure.
And to jump right into it, well, when we talk about risk, it's the possibility and probability of a loss or just a lower return than you might think you want to get or expect to get, So when we start the conversation, we like to outline just some general principles of what loss can be, what expected returns are, and what they're looking for. And then we kind of just open it up to them. And I think the bigger part of that becomes more of behavioral finance and risk. And it's like, what do they think of the market? What are their expectations, and what are their what makes them upset? And then we kind of go from there. So
let's break it down, because as I'm saying the word risk, and I remember our schooling from the earlier years.
Sure.
There's inflation risk. There's I forget some of the other ones, but liquidity
markets, interest rate. There's a million of them. There's a lot of risks.
Right. So let's identify that now that
sure.
we're in there, because I think to the immediate response you're talking about is market risk to people's performance in their portfolios, which is what most people will think about.
Sure.
And I've used the line over the years: do you like to eat better, or do you like to sleep better? And in essence, that starts to define people's risk tolerance when it comes to the fluctuations of their assets.
Yes.
Yeah? Okay.
We call it the sleep at night portfolio, right? So we want our clients to be able to sleep at night and not be thinking about this. If they are thinking about it, they're thinking about it in a good way, and how it's going to turn, their retirement's going to turn out, and how everything will be as they want it, as opposed to taking on too much risk and losing sleep.
Exactly. So, but some of the things we just talked about is there'll be the nervous Nelly who likes to sleep better and is underperforming against taxes, inflation. She has her liquidity, but she's not keeping pace. And then depending on the projections, how large their asset size is, what are we in jeopardy of? We're in jeopardy of running out of money because they're not getting a certain level of performance. So to kind of clarify where I'm going with this is, what's the point of planning? The financial plan, you as a certified financial planner are giving people projections into their future. This is what we're delivering. And it's showing them, hey, based upon the path you're on today, these are the things that you're doing. These are the things you can control. This is where you're heading. Question is, based upon the factors of inflation, liquidity, all of that the other risk, not the performance risk itself,
sure,
but the inflation risk type of things. Are you in jeopardy of running out, or what does the shrinkage of your portfolio look like? So risk is really several different components of conversation. True?
Yeah, absolutely. And, when you're talking about, today's headline is obviously interest rates and inflation, right? So that's, everyone has these, these biases, these behavioral biases. And right now, they're looking at the TV and they're seeing all these numbers. They're not realizing that we've been disinflationary for, 10 years plus. So you got to kind of set the parameters, so to speak, and you have to explain to them that what they're seeing right now isn't something they might be seeing for the next 10, 20 years. And how you do that is, we use our software and we use all our systems to kind of, like you said, show them based on historical facts, what could be with your portfolio if you align it right with not just your risk, but just a tolerable risk. Because, two things I see all the time is when I look at a portfolio is, one, people are a lot riskier than they think they are. So once we analyze their portfolio, they've been told, hey, you're a moderate risk. And meanwhile, it's much different than the way they think it is. Or the other way, like people think they're getting so much return, but they've maybe just been lucky, or they've had a couple assets that overperformed, and they're really not. Their gut is they're conservative people, and they're just way out of their tolerance. So when it comes to things like the now moment, the inflation risk and the interest rate risk, we try to kind of push that down a bit and say, there's always going to be something. And once again, if you're going to sleep at night, we got to kind of set the parameters, set the expectation, and help them understand that some things just are happening now, but they're not going to be happening in the future, and they haven't happened in the past. So, once again, just talking to them about current events, so to speak, but how that really doesn't affect the portfolio as much as they think. And then we set in, all our portfolios, we set in inflationary numbers and expectations, and we could show them high inflationary years, low inflationary years, combination of both. So, sure. It's talking about it and it's illustrating it.
It's come a long way from the 80s when I started, when software didn't exist. So we have tools now. The modernization and technology is able to give, I think the term might be Monte Carlo, right? You get to give the Monte Carlo illustrations, which, folks, basically is we're going to beta test something 100 different ways to see the variety of outcomes. And then where does the majority lie in that Monte Carlo, and where are the outliers? And so what you're looking for is that pattern of consistency. I say that right? I haven't said that in a long time.
Absolutely.
Is the parameters of where somebody's going to fit within that certain zone. So if you use the term moderate, so a moderate risk taker, their expectation might be between 6 and 8%. You can't guarantee them 6. You're not guaranteeing them 8. You're not guaranteeing them anything. And by the way, folks, as a disclaimer, because I didn't say it, we're not telling people what to do. We're not giving people specific advice. We're having a conversation on how these things work and how to interpret them for your own personal use. So we're going to put that disclaimer in there to protect Andrew here. Is we're not giving you specifically, the listener, direct advice to go out and do this. You don't need 6%. You don't need 8%. We don't know what you need. You can talk to Andrew. You can talk to me. Talk to your own financial advisor. But FYI, we're not telling anybody what to do. But if we go back to the 6 to 8%, well, then that Monte Carlo is going to kind of point us in what's the likelihood of you achieving the success based upon those parameters. Is that how you?
Yeah, and you said something interesting there. You said we don't know what you're looking to achieve. When we sit down with a client, we don't know what they're looking to achieve, and it's only through speaking to them and learning about them and learning about what they're looking to do, when they're looking to do it, when I'm looking to retire, what I need in retirement. It's kind of a living, breathing thing. We got to sit down and kind of define what is retirement and what is your retirement, and then the tools come in. And you're right, we have a lot more tools now, right? So not only can you do a Monte Carlo, you can really see historically what investments are gonna have the highest probability of what loss versus what risk versus what potential gain. So that stuff to me is the easier part of it. It's getting the client to kind of, they don't need to have a perfect understanding of all this, but just understand where they're at, where they're looking to go, right? And then we try to get the best vehicle to get there. And then from there, it's it's ongoing. It's not set it and forget it. It's something that changes. Well, with monthly, quarterly, yearly, it's a living, breathing thing.
Well, that's what I say is the second it's created, it's obsolete. Because all we're doing, all a financial plan is a snapshot in the movie of your life. It's a Polaroid. For those who know what Polaroids are, I'm really dating myself. You know what a Polaroid is.
I know what a Polaroid is.
You do or you don't, son of a bitch.
Absolutely.
Oh, okay. I thought you said no. If you're taking a picture of somebody's life that's in motion. And the second you take the picture, they've already moved, the markets have changed, inflate, whatever it is, there's all these other parameters of influence. And so the plan, as you just said, is it's a living, breathing organism that's ever changing. So all we can do, and what I want to do here too, is to speak up in support of you, me, and other advisors out there, the difference in the commoditization of financial planning and asset allocation and Monte Carlo. There's a ton of do-it-yourself stuff out there. You can go get a robot to make a planning projection for you, right? You could probably do Chat GPT and have it do something for you these days. What you're not getting is my 36 years of experience, Andrew's 24 years of experience, to poke at you and really ask and dig deeper into the emotional side, the reality side of things, and put mud on the wall for you to think about saying, well, what if this happened? What if this happened? What if this happened? I'm going to date myself again. The old E.F. Hutton commercials, for those who remember when E.F. Hutton was around, is people you say, oh, my financial advisor told me about blank, blank, and blank for my elderly parents. And maybe they were talking about long-term care or something, right? It was a planning conversation. And the one friend says to the other, well, how did you know to do that? And the response was, my broker, Dave Hutton, asked me. So again, it's I've worked with 1,000 families at least. I'm sure you've worked with something comparable to that. How many different scenarios have we encountered? But at the core of it, it's still the same epicenter of things, right? There's only so many variables. And so it's getting into the head, the psychology. We talk about this all the time, as you and I wear a psychologist's hat as much as a financial advisor's hat. Because people with money are facaded, right? They're a little, it can. So anyway,
sometimes I say I'm your financial bartender. You just come and you kind of tell your life story to me, and then we work it out from there. But also to expand on what you said before, it's not just there's a bunch of robot asset allocators out there, and that's all great. And you're going to love it, and you're going to be into it for about 3 days. Then you're going to kind of forget about it. It's not going to be intuitive to change with your changes. And the other thing is, someone like you, especially, you have a network of people, of professionals who you can reach out to at any time. Your phone is a very powerful tool right there. You can reach out to accountants and lawyers and whoever in your circle, and you can get answers for your clients. And that's something that most of the time they're very hesitant to do by themselves. They're not just going to pick up the phone and start dialing, accountants for random questions. But we have those connections where we can help, not just look at some asset allocation. We can help with the whole general holistic financial planning, like everything. And that's where we bring the value. It's not just the tools.
The terminology is we're your financial doctor, we're the quarterback that runs your team, we're the navigator of your ship. And all of those are interchangeable. But what Andrew's basically saying is, at least, in our world, I can't speak to what other people do, is we have a network. We're value driven. We want the clients to come to us as a conduit. Yes, we're their financial planners. Yes, we help them manage their money and set their goals, but there's other things they need and they may not even know they need. And it's our job to prompt and ask those questions and then say, you know what? You have an elderly mother. There's a long-term care situation here. What have you done for that for yourselves? Maybe that's something we should be visiting. Now, you and I jump on that early. We get into that, based on the age of the client, is we're qualifying them or pre-exposing them to, look, this is what's going to bite you in the backside when you start hitting your 70s and 80s. It's not the market. It's not inflation. It's health expenses. What are you going to do about that, right? So you just start throwing things at them to chip away at it. And they say, oh, I took care of that last year with somebody else. Great. Mark it off the box. Took care of it. Didn't take care of it. Let's have a conversation about it. I don't care if you do or don't do it, but it's remiss on me not to describe, educate, and let you make the decision. And then if it's affordable and makes sense, then we'll help you implement it. And that it's just piece by piece by piece. I got a line for the other show the other day. You don't know what you don't know, so this is why you got to listen to my show. Go ahead.
Perfect.
You like that?
Very good.
So let me hit you with another question.
Sure.
I got to come up with it, but let me hit you with one. Did you anything you want to add to that? We're going back and forth.
Well, I think one of the things just to add to that is when you do go see a financial planner, in my opinion, they should have a pretty healthy checklist in front of them. And they're all talking points. And I think to just hit on one thing, whether it be how your investment's performing, would be ridiculous. Like you said, usually we have 4 or 5 meetings to kind of get to really the general area where we're going. Because, one of the first things on my checklist will be, do you have a will? Do you have a power of attorney? Most people don't. Yep. So there's a stopping point, and we speak about that. So, whoever you're going to see, there should be a very substantial checklist, because if you're going to do true financial planning, you got to hit on a lot of topics, and it's something that's going to be evolving and moving. And that's the whole point of it, is just have someone as that guide and that coach.
You're a certified financial planner. I've shared this with others. There's 82 subtopics on the CFP exam. Not 82 stock market questions, not 82 life insurance questions. There's 82 different topics that a CFP has to be educated enough on, or at least speaking points on, or know where to find it in the manuals when it comes up. And my point behind that is exactly what you're saying, is there's so many things to be addressed. They're not all applicable to every single situation, clearly. But if you don't have that protocol in your head of, these are the things that I know you're going to be facing as a client in your future, whether you're 30, 40, 50, 60, 70, then we need to address these things, and we need to know we've at least spoke about it. It's been entertained by you what to do, and you've made a decision. And then guess what? I put it in my notes that we discussed it, and you said no, or you implemented. And so when you didn't do something that I thought was detrimental or you thought was detrimental, I know I have it in my notes. We spoke about it, right? So I'm not going to be, oh, you never told me. Worst line I ever want to hear from a client. You never told me. Oh, I absolutely did tell you. And here's when. I got a document. Right. Here are my notes. Right. So, right. So in regards to all that information, you mentioned the multi-meeting process and where I wanted to go with that a little bit. And it's kind of back to the doctor, the financial doctor. And I can't emphasize it enough in my talks and the shows. If a doctor's giving you a medication after 2 seconds, that should be a warning flag. If an investment person's calling you over the phone to sell you something, I don't know if people still do that or not, and they don't profile you, they don't know your situation, and they're giving you an investment recommendation, is that not a form of malpractice, like a doctor giving you a medication without even talking to you? And that's what goes on is people, they're looking for the one-off. They want a hot tip. They're looking, this was the stockbroker back in the day that you and I kind of came from, but I never really did business that way, even when that's what was being done. I was always kind of asking questions and qualifying things and getting to know the situation. And, where the Merrill Lynch's that I was with at the time wanted me to sell something of theirs, I'd be like, Andrew, it sounds like there's a baby crying in the background. Let me ask you something. Have you done anything or thought about college planning yet? Like, now's the time, you have a newborn? Or if it's a life insurance scenario, like, look, it sounds like you have a family, have you looked at your life insurance needs? Like, what's keeping you up at night? Right. So it's not like, hey, I got this great stock tip for you. It's, tell me what's keeping you up at night. Like, what can I do to help you? And that was the early precursor to what, financial planning. CFPs did exist in the same, they existed. They weren't as vogue. It wasn't as mainstream until the mid to later 90s, where financial planning became the new push. And as rightfully so, it should be.
Yeah, but, to also expand on that, there's really, you can look at it really at its basic. There's three things CFP should be looking for. There's wealth accumulation, and that's kind of the one that, we got started on here. But then there's protection strategies, and that leads to your insurances, right? And then there's simple budgeting. I mean, many people come to me that have enormous amounts of debt. And, before you invest, you really got to look at the debt side of things, because, if you've got too much credit card debt and you're paying 22% in interest, well, whatever you're making in the market is not going to help you. So, we kind of look at it from several different areas. And once again, just going back to that CFP and all of the principles, there are just so many things. And listen, I'm not an expert on everything, right? I know what I know, and what I don't know, I either look it up or I call somebody. But the thing is, there are so many things to touch on. So I think that's been our job, really, when you talked about the doctor. Like, look, there are specialist doctors too, don't get me wrong. But for the most part, we're general practitioners, right? We're the family doctor. Like, we're just kind of putting you, where we think you need to go. And I think it would be malpractice if you didn't look at all those things.
100%. The piece you shared in there with the questions, and I I know what I wanted. I totally have a brain. The financial house, that's where I was going, okay, is if you think about building a house, what Andrew's talking about with budgets and cash flow and use of credit and cheapest use of money, well, think of that as the foundation of your house. And when somebody only wants to talk about investing and stock markets and Bitcoins, well, they're upstairs. They're on the risk side of the house, but they don't have a foundation. And the foundation is, how's your cash flow? How's your debt ratio? Do you have your insurances in place properly? Because if any of those things go awry, it doesn't matter what's upstairs. The whole house is going to collapse. So we always used to use that analogy of, you got to start with a solid foundation. And that was a cash reserve, being debt-free, positive cash flow, and then having the proper insurances in place, whether it's life insurance, disability, obviously their auto, their home. But what do you need in the insurance world? Because now if you're going to actually buy a house and have a mortgage, Are you going to take care of your family if something unexpected happened to you or the spouse, right? How do the kids not lose their home? How does your significant other not lose the home? And so that's proper planning at the bottom. Has nothing to do with investing yet, right? We haven't spoken an iota on it.
But it all does tie into risk, right? So when we started this conversation off with risk, well, you want to be risk averse. Insurance is the way to do that. So that's, when you're talking about risk, a lot of your risk can get cut if you just have the proper insurances, like you were just speaking about. And there's quite a few of them, but in today's society, we're in a litigious society, and there's that end of it. There's also death. Look, you pass away, you lose the cash flow, your family could lose the house. So you got to look at that. It's important. So when you're talking about risk, insurance is a big deal.
Yeah. It for those who don't know, life insurance proceeds are tax and inheritance, not inheritance, but they're income tax free. Let's start there. And so that goes back literally 300 years to the Widows and Orphans Act back in jolly old England, because sailors would go out to sea and never come home. And the government was taking care of all the widows and orphans because the sailors, were exploring the world and weren't coming back. And so they're like, well, give us a couple of shillings and we'll give, some life insurance. And also remember back then, jolly old England had like a 95% tax rate. So anything you made went to the government. So they made it a tax-free, life insurance proceeds, which in this country, stays true. So, yeah, you want to be able to provide liquidity and access to capital if a crisis like that happens. And then as your time goes by, not that we'll make it a life insurance conversation, but as time goes by, you do it for other needs. But to that exact point, literally this week, 2 phone calls from clients. He's turning 70, just got diagnosed with diabetes. What do you think he wants? Can I get $1 million? Can I get $1 million of life insurance now?
Of course.
Are you kidding me? Like, yes, maybe it depends, but are you prepared for the sticker shock of what that premium is going to be like, bro? Like, what are you doing here? Like, you just, and then again, the cost of waiting is a risk, right? Here's another one. We get cost of waiting, because now your health has changed. You never thought about it in your 30s, your 40s, your 50s, your 60s. Oh, you're turning 70. And you got a bad diagnosis of health, your health just changed. I may not be around as much now. I better get my wife some life insurance. Yeah, okay. Well, it's 80 grand.
It's the same as credit. Right. Well, it's the same as credit. They always said, when the time to apply for a loan is when you don't need it, right? Because that's when you get the best deal. It's the same thing with life insurance. It's the time you need to get it when you're healthy and you're not thinking about it. But it's human nature. Most people don't allot their money to that. And once again, a lot of our job, yours and mine, is sometimes pushing people to make those decisions, pushing them in the right direction to say, hey, look, I know it's not on your radar. I know you're not thinking about it, but that's the time to be doing it, is when you can get it much cheaper than you would if, once again, like your guy gets diabetes. So, once again, that's one of those intangibles that we do that isn't picking a stock or a mutual fund or whatever, but it's something that when we meet our clients is always on our radar. Hey, do you have coverage? Well, this may be the best time to get it. So it just plays into planning. Basically,
to me, the plan man is about proactivity. It's just being proactive. Again, not that I'm trying to throw my clients under the bus, but the stuff with health insurance, we do so much health insurance, and the younger they are, the worse they are. They're like, I don't need health insurance. Well, I ran into a 22-year-old that has $75,000 of medical bills, forced her into bankruptcy because she came down with some rare heart ailment, and she had to have all this massive surgery, and she was uninsured. And then good luck getting insurance, after the fact. Like, right. Oh yeah, now we want you. Yeah, now we want you. It's a small fortune, and yeah, it's. I'll repeat it because I use it on their episodes, and it's a great line. Walk around the hospital, every floor but the maternity ward, and ask anybody in any bed in any room in the hospital outside of the maternity ward, hey, Andrew, did you plan on being here today? I mean, obviously, if it's elective surgery, okay, so stay off of that floor. But, anybody in ICU plan on being there with tubes down their nose? Like, come on. Like, insurance is a pool of everybody's money to cover commonality of risk. I've touched on this in other episodes about adverse risk. People complaining, why are my rates so high? Why did rates go up in Florida? What's happening here? And again, it's just a matter of understanding how this stuff is derived and what it is at its core. So when you are young and healthy and it's less expensive and affordable and you poo-poo it and don't want it, Well, you're causing the statistics to be higher for those who are in it. They're going to pay a little bit more. And then guess what happens when you finally show up and want it yourself? It's going to be that much more. And in some cases, now you're not offered it. Again, diabetes, just to tell people who don't understand, like I'd say probably less than half the time, they're just declined. They're not even made an offer based upon what's happening. So, once you get that, and oh, by the way, like what an epidemic of diabetes in this country, not to go down that rabbit hole, but this is, there's issues. We've had shows on health and wellness, and the big thing driving my weight loss was like, I didn't want to, turn into a diabetic. I wanted to get my weight under control and handle that better. So, and we've had guests on the show talk about their near risks and getting off of that. And by losing weight, all of a sudden that predisposition disappeared. Well, lo and behold, right? Eat better. So all this has influence. And oh, is that another type of risk? Yeah. Look at that.
Quite a few. We
got to start. I should have been writing them down, all the different types of risks. But so we started with portfolio risk. And so let me kind of tie in where I wanted to go with this, because some of this in my world used to be talking about asset allocation, which is the portfolio design that kind of backed into where people want to be. So the plan, let me set it up. The plan itself, I'm going to go back even further. You may have a different point of view. My point of view is I used to say to clients, there's three things you can control, Andrew. You can control the timeline to when you retire, how many years that is, right? Age 65, 62, 67, whatever it is. You can control that. You can control the amount of money you spend and or save. How much can you save now? How much do you want to spend in retirement? So that's your budget, right? So timeline, budget. And then you could control in some capacity the performance of your assets, which is the risk, the management, exposure to your portfolio. You only need 3%. You can go buy 3% CDs, then keep all your money in CDs and have at it. You need 9%. Well, now you got to talk about how you're going to get 9%. And back to that Monte Carlo and, all of that type of stuff. Like, where can you consistently get with the least amount of disruption that so-called 9%? And so I back that into the terminology that people have heard, and we're going to talk more about, is asset allocation. So the risk management of the portfolio, and what you were alluding to earlier, was basically, where are we putting all this money? What kind of portfolio are we designing? How are we going about doing it? So you expand a little bit more on your takes on asset allocation, and then I may have a piece or two to add.
Sure. Well, the first thing, just getting to what you just said. So a lot of the conversation that I have with clients is, what is the number that's going to get you where you have to go, right? So let's use your 9%, right? Let's just say it's 9%, right? There's something called a risk-free rate, right? And it's based on an inflation, and right now, for the last 10 years, let's say, the risk-free rate was basically nothing. So there was no interest rates, right? You went to a bank and you got a CD, they laughed at you. It was 0.00, and then it just kept going.
Paid to have deposits sometimes.
Yeah. So people were forced to take a lot more risk, because what they do, they put that money into the market, right? Now, all of a sudden, within the scope of 8 months, the risk-free rate went from 0 to 4, right? Because interest rates, you can go to a bank now and get a 4% CD all day long. So our conversation always is, well, what's it going to take? If you're my client, Bruce, and you need 4% to get you to your goal, you're not taking any risk, because I'm going to put you in product that gives you 4%, right? So when you talk about risk and asset allocation, right, it's what asset allocation is going to be the least amount of risk, but it's going to get you where you got to go, right? So that's kind of the beginning of the conversation. And I think it's changed so much in the last 8-9 months, just because of where we are with interest rates, and are they going to stick, and is it going to, are we going to be disinflationary at some point, yada, yada, yada. But the point is, what we do is, once we come up with that number, which has a lot to do with, just basic numbers as far as retirement, but some behavioral finance. What are you willing, for 9%, you're going to take a lot of risk. Is your gut going to take that? So then that kind of falls into it too. Once we get through all that, we get to that asset allocation. And you and I have had this conversation many times. It's your traditional stock and bond portfolio for the last year or two failed most people, right? Because if you were that 60-40 guy and you were expecting that 40% to prop you up in a bad market last year, what happened? That 40% lost 15%, right? So you got to be a bit more. You got to look out more into the world these days, and there's all these products we won't get into, because we're not going to get into products. But your your insurance and investment guys need to come up and strategize and look at things from that 40,000 foot view. Just look at everything, because that asset allocation, once again, least amount of risk, gets you where it's got to go. Hopefully it performs even better than we think, but at least there's an average return there. Let
me stop for 1 second. You keep hitting the table, and the camera's moving, and you're shrinking. You're shrinking on the camera.
There we go. We're back.
Go. You started tight, and
I know
you're up to my chin.
It's my heritage. I talk with my hands. Right? Usually my hands are flying all over the place. I could probably make a salad while I'm talking.
He's disappearing. I'm like, where's he going? I gotta bring.
I'm not the tallest guy, but I don't want to be too.
Bring him back. I'm like, so I'm sorry. So we digress, but I was.
So just getting back to that, right? Like you now you're at the point where you can pick your assets, and that to me. That's, I'm not going to say that it's fun to me because I'm in this business, right? But that I think where it gets interesting to clients is the asset allocation. But there's so much pre-work that goes into that beforehand to just determine what they need and what's going to get them where they got to go.
The planning work is done, but I liked what you said is it's the least amount of risk required to get you where you want to be. And I think people need to write that phrase down as one of our so whats, okay? Is the asset allocation is what is the least amount of risk I can afford to take or need to take to help me reach my goal and objective. And so the plan, again, it's the horse before the cart, folks. So the plan is going to basically say, Andrew, I'm making this up. I want to retire at 65. I want to have an after-tax income of $10,000 a month that I can spend and maintain a lifestyle. I have X amount of money. I have a pension. I have a Social Security. Nobody has pensions anymore, but some people, let's say, I have a pension, Social Security, and I have a nest egg. How do I make all of that work? That's the ambiguous part of the conversation. I call it X factor. What's my X factor? And then based upon some normalization of inflation, whether it's, and again, I don't want to go down these rabbit holes we touched on before about zero inflation for 10 or 15 years. Historical inflation's 5%, folks. He and I are old enough to know when this happened, and all of a sudden now we're back there. But somebody who's in their 30s or 40s experienced their adulthood in zero inflation. How do you convince them that they should be plugging in 3 or 4% for the rest of their lives? They've never experienced it. Well, we're here now, so let's find out where this game's going to go. And by the way, what if this becomes the 70s when it's double-digit inflation for 7 or 8 years? Now what are you going to do? So these are things, we said earlier about the organism being living, breathing, and ever-changing. This is why it's not put it in the safe and forget about it. It's quarterly reviews, it's semi-annual reviews, it's annual reviews, whatever it is. It's just not ignoring it. If nothing else, we always tell people what? If you have a life event, give us a call, right? Any kind of life event, we need to know about it. Marriage, death, divorce, child, job change, move, life events. Because now there's disruption here. We got to start figuring things out. And the list again grows of, do you need this? Do you need this? Do you need this? And for me, being a transplant from the Northeast, coming down to Florida, I mean, you're still up there, but how many millions of people have moved to Florida? So they need new homeowners insurance, new auto insurance, new health insurance, new Medicare insurance. They might need a new financial advisor. They may keep their financial advisor up north. They might want somebody down here. They got to do their wills, trusts, and estates because it's Florida law versus New York and New Jersey law. Like there's so much in motion. And so if you don't tell them and I don't tell them, hey, make sure you communicate with us or you and I are reaching out to them of, hey, what's going on? Anything new I should know about? Oh, yeah, my wife's pregnant with triplets. Oh, what are you going to tell me? Right. So proactivity in that regard, again, I'm sure I went down a rabbit hole. Bring me back. Bring me back.
No, but just to what you were saying, I think that, we reach out to our clients quite often. Our clients, we expect hopefully that they're going to kind of reciprocate and tell us about those life events. But, your financial planner isn't, I would say, I'm going to blanket statement this, but if your financial planner is calling you, they're not calling you to sell something. Okay, I'm gonna have faith in most planners out there. They're calling you because sometimes we have to prod our clients to find out about those life changes. So pick up the phone and talk to them because we can't tell if Sally's pregnant or having triplets, like you just said, right? But these are things that look. A job loss it can be a huge change, and we have to plan accordingly for that because we have to change your risk, right? So if there's money that we're managing and all of a sudden your risk tolerance went from here to here. Like we have to have those conversations. So I think when, like you said, you get into these life events and proactivity, we're being proactive calling. You got to also kind of reciprocate, and that makes the relationship work.
It's tying something else you hit as well is when the phone's ringing, they're not trying to sell you something. So let's talk about that, because that's the difference between a fee-based financial advisor, fee-only financial advisor, or a transactional financial advisor, right? So you guys, as far as I know, are predominantly fee-based, right?
Yeah. We have to hold ourselves out there according to the CFP board as fee and commission based. However, I would say we're 95% fee based. The only time there would be a commission based product is if there's something out there in the world of products, once again, because we as fiduciaries, we're always acting in our client's best interest, and we have to look at every product out there. And if there is some sort of product that is only a commissionable product, we would use it. But I would say for the most part, that doesn't come up anymore. But you never know. Like, I put it out there because, there are things that, some people ask for, or whatever the case may be. But you could say fee based is our bread and butter. And I think that's the future of the industry.
And
I think it's great.
It goes to what you said, is because if that's the established relationship, you're paying a fee involved for the service and the conversation and not the transaction. So you shouldn't have phone phobia. Ugh, Andrew's calling again. It's the 28th. It's the 28th of the month. What's he selling me today? Which is what we were as stockbrokers in the 80s, right? Oh, how come you only want to sell things in my portfolio on the 29th, Bruce? Like, Merrill Lynch is recommending you sell your XYZ for the PDQ, and you got 18 minutes to the bell, rings and the market's closing. Like, yeah,
those days are pretty much over, thankfully, and I mean, look, that's something that people just have to completely forget about and realize that
it's professional.
You're paying for our time, use it. I said, they're paying for our time now, so use it. Like, get on the phone with us. I mean, please, the more conversations, the better. So that's what people need to kind of change their mindset.
The paradigm has moved to win-win. Okay. If I don't have anything to sell you, I'm providing you advice in exchange for a reasonable fee, an expectation of a fee. There's no transaction involved. Whose interest am I truly executing? Mine or yours? You, the client. Now, if it's commission-based, you have reason to say, is it better for Bruce because he's getting commission? Oh, he's just trying to sell me life insurance. He's trying to get a commission. All right, well, yeah, insurance is unfortunately just commission-based products, right? But we tell people the insurance companies pay us. It's built in. You don't pay any more. You can go buy the insurance online, your auto, your home. But when it's midnight, we had, I don't think I said this earlier, we had a client that got admitted to the hospital last night, and she's panicking because they're telling her her insurance wasn't valid. Well, if she called Geico, not that Geico does health insurance, you think that agent's going to be on the phone with the carrier in the hospital and helping her while she's laying in the bed dealing with what she's dealing with? Like, that's what an advisor does. Okay. Now, was I paid $1 million to give her a health insurance plan? No, not even close. Right. But that's the relationship that I deliver. And so you want that mutual respect and relationship with your advisor. It should be win-win. And if any point in time as a client, you feel like it's not win-win and you're on the losing side, either address it with your advisor or go find another advisor.
And that's the beauty about a fee-based practice is if that does, we can shake hands and move on and no one's hurt. And that's the beauty of it. And that's a very good thing that this business has transitioned. I hate
to say these things, but back in the 80s, when I started at Merrill Lynch had their own products and mutual funds. And back in those days, they were not transferable. So if you as a broker left, your client wanted to leave, they actually couldn't take the assets. They weren't transferable. Today's world, everything's transferable. There are no products, or almost everything.
Do you know, and I'm not going to mention names, but from a very large and well-known brokerage, I just ran into that last week where they had non-transferable proprietary mutual funds. So it still happens. And I can't believe that it still
fee-based funds.
So we had to call the firm.
Fee-based funds.
They were. It was a fee-based account, but they had a little disclaimer in their statement that basically said that this firm is also making money on a trail side in the fund. It's a proprietary fund. And I said, how's that possible? But we couldn't transfer them. They're proprietary funds. And like you said, I thought that was dead. I really thought that was a thing in the past, but I just ran into it. And we're talking about a massive company.
Let's talk about the so what. Like, so what is, if this is something, a position, set up the scenario. The client's been with this investment company, portfolio, whatever, for many, many years. It's in a taxable account and has massive capital gains. The fact that it's not portable, if they want to move it to Andrew, they have to liquidate it. It's not transferable. So liquidating is going to do what? It's going to cause a taxable event. And now they're going to have to pay capital gains on that. Now, obviously, if it's in a tax exempt account like an IRA or something, it's not a problem. Right. But if the client loves that investment, Andrew can't keep it for them on his side of the table. He may not have something similar to it that the client's willing to take. So now all of a sudden that asset stays behind and it's running autonomous somewhere else, right? So it just becomes problematic.
So you can look at it as either very brilliant or very devious. You know what I mean? Depending on which side you're on in that conversation. Yeah, well, okay. But with that said, listen, one of the most important things about our job is, I'm product agnostic, right? I don't care about any company's fund. It's just gotta pass our analytics. I don't care what the name of it is in front of it, as long as it passes our analytics. So, in this day and age, there are still a lot of companies that rely on maybe one certain company, or take all their, shuffle a lot of their business towards one certain company. We don't do that. And I think that's also something that the CFP community's obviously embraced. But, look, I think whoever someone works with, make sure that their metrics don't include just working with a certain fund company that takes them out to dinner. This business, that was something that was pervasive for a very long time.
He's got two things going for himself, folks. He's got the CFP, Certified Financial Planner, which provides fiduciary responsibility. Okay, so if you don't know what that means, you can go Google that, but it certainly means he has to put your interests first over his, anything that he recommends. He's got a fiduciary responsibility, literally upheld in the law of court, that did he do the right thing? Okay. Second is he's an independent. So he's out there in the universe with an open platform. He's not working for a specific company. He's not pushing anybody's agenda. It's how he and his partner, Brian, decide they feel from their 50 plus years of experience in the business of how to best go about this. So those are the kind of characteristics you want to look for when you're seeking financial advisory advice, and put the horse before the cart and do the planning and then back into some of this and have those conversations. Real quick, it was the front line of where I wanted to go today, and we're haven't hit the point yet, is I want to break that down, because we're talking a little about asset allocation. You're talking about you're agnostic, which I thought was beautiful here because it ties us back in. So the numbers, as I recall it, asset allocation, which we said earlier was the least amount of risk to make the appropriate rates of return for success. What I've always shared is 91% of your success will come from being properly diversified by asset class. So there's your agnostic, right? I don't care if it's Joe Bob Bims or Mary Jane Sims or whoever it is. If it's large cap, if it's small cap, if it's international, if it's bonds, if it's cash, those are all different types of asset classes. And then the question is, and people have seen the pie charts, maybe they've seen the chemistry grids, what do they call them? Quilt charts now, is asset classes are these different color boxes, red, blue, yellow, green, orange, and they go up and down, and they all move in separations of each other. And you said the 60-40 before and the 40 disappointed. So I want to put meaning behind what some of that was. We kind of glazed over it a little bit in the topic. But so you're building this asset allocation. The risk model, Andrew's going to say is, and we'll just go keep it simple. You said 60-40 before. So what he was referring to was 60% of your money is in equities, i.e. stocks, not necessarily individual stocks, but a portfolio or mutual funds, right? And then 40% bonds or fixed income. So that's, if you correct me, that's what you were referring to when you said 60-40, okay? So exactly. in simple terms, we're just going to keep it simple. A 60-40 mix is the asset allocation that you've deemed to be appropriate risk for that client to get them where they want to be. Now, whether that 60-40 mix has historical rates of return of 2% or 12%, we're not going to dicker over that. That's the right risk,
Okay.
whether it's, 3, 5, 7, 9, 12%, doesn't matter. That's what we determined works for the financial plan. And now we want to go and do that. And 91% of the statistics show your success will come from just being, that's your major headwind, is just doing that. But then the next line is where the agnostics start to change. And that is 6% of your influence is now picking the better fund and fund managers amongst their peers. And so my point behind that is Andrew, being an independent, has much more exposure and opportunities for portfolio managers than somebody who works in a captive shop. If somebody's only pushing Fidelity funds because they're at Fidelity and they're not looking at T. Rowe Price and they're not looking at PIMCO and they're not looking at American funds. And again, I'm not name dropping all these names, but the point is,
Sure.
Who's the best in their category? There's over 10,000 mutual funds. Now, I'm not throwing shade on Warren Buffett. He's genius and he's got a nicer car than me. So, amongst other things. So, Warren's from the camp of, don't sell. And, him and some of the others talk about just buy index funds. If you don't know what you're doing, just buy the S&P 500 or buy index funds. And that's fine. And the rationale behind it has been that 78% of all mutual fund managers are outperformed by the index. So he's going with a 4-to-1, 5-to-1 ratio. If you don't know what you're doing, just stick with the index because you got an 80% chance of success just getting what the index is anyway. And that most of the managers you're going to hire stink. Well, I've always flipped that. Is if it's 78 fail, that means there's 22 that do beat it. And if there's 10,000 of them, that's 2,200 managers out there, right? So It is doable, and that's what the software and the tools that Andrew has to make a 97% success. I'll give the last piece, but go ahead, jump in.
Well, what I would say to that is, I think there's a little bit of right in Buffett, and there's a little bit of right in us. Like, I think that if a lot of times my clients' children, I always say to my clients, have your kids call me, whatever they want to know, 401k, whatever, any question, any financial question, just call me. It's fine. I'll always pick up the phone. And I think that if you're a 22-year-old kid and you don't know anything about investing, and if you buy an index, that's awesome. Great. Just be invested, right? So there's time, right? There's time, there's risk, there's all these things that factor in, but time is a big part of this calculation. If you've got 40 years to go in the market, you know what? You're going to buy an index. Great, because you got 40 years. And in that 40 years, there will be underperformance, but there'll also be performance. So that's great. But when you get, and this is where more of our niche, I think you and me, is we get those people who are more, maybe not at retirement, but towards retirement. And they've developed a bit of a nest egg, and they want to be a little more careful. And they want to not take the ride, so to speak, the volatility ride of the S&P, whatever the case may be. Then that's where we earn our stripes, right? And there's something called alpha. It's measurable. If someone is beating the index, they generate what's called alpha. So we look for managers that do that, and a little can go a long way. But I guess my point is, I agree with Buffett. If it's someone who is a young guy who has some money and he just wants to put it into something, that's awesome. I'd rather see people invested. That's great. But as you get towards retirement, you got to be careful, and so that's where that more active management style, to me, comes into play.
I would go as far as saying it's training wheels versus removing it to then moving up to the 10-speed bike as a kid, right? So we get that starter bike. We're not ready to go on our own, so we have the training wheels. So in S&P 100, you'll help an existing client's family because you have the relationship. But if a strange and I'm not in your pocket, your client minimums or anything like that, but the big brokerage firms have minimums. Somebody has $100 a month is not going to go to Merrill Lynch or UBS and have a financial advisor give them all these things. So that's the training wheels. Not everybody's born with $1 million to open up an account at Goldman Sachs. So where can people get advice with low entry points? And that's where, to me, when you go to a Schwab or Fidelity, Vanguard, and you could put away and do a bank draft and $100 a month or your company plan at work, you're still in the training world space. And then, and again, this is lessons of our upbringing in the spaces. You should have no more than 4% of your money in any one stock. So if you were buying stocks, you got to have at least 25 of them, right? 4 into 100 is 25. So that would be more diversified. And that's, I think that's a Warren Buffett rule too, is no more than 4% of your money in any one stock. So now in that regard, again, the world's changed. The Robin Hoods out there, you could buy fractional shares. You and I, if you didn't buy a round lot back in the day of 100 shares, you got hosed.
Yeah.
You couldn't buy 2 shares.
Absolutely.
You certainly couldn't buy a half a share. Absolutely. So again, the world's evolved. So you could do fractional share buying and take $100 and put $4 into 25 stocks, I guess. But again, you're splitting minutia here. So eventually, when you get to that point where the training wheels can come off and you could start to converse with a financial advisor, the benefits are, to get into some of the buzzwords Andrew said, is you get into more managers with alpha, which is the measurement of outperformance, right? It's how do they do against their peers? Think of it like handicapping. Like, I'm not going to play Tiger Woods head up in golf. I better get some points. I got to get some strokes, as they say. So alpha is basically, hey, your risk is a 2, my risk is a 0.8. We're not matched head to head. We're not going to get into all of that standard deviation like nonsense, right? But what you're trying to do is give somebody a lower risk exposure, but still give them bump when bump times occur. But when the storms are here, they're not going to get clobbered, right? All things go well till you get punched in the face.
Yeah.
Right? Everybody's got a plan. So, So
everyone has a plan until they get punched in the face.
You and I know that 5, 6, 7, 8 years of a good market, everybody thinks it's easy and they want to keep expanding their risk and rolling and rolling and rolling. But just like the casinos, eventually black's coming up, folks. Eventually the dealer's not going to bust. You're going to bust. So all good things come to an end unexpectedly, otherwise they don't end. So the markets have been good. It's been a very strong 10-year window since the housing crash of 08, 09. Where are we going? Inflations are up. And again, it's a whole nother meeting of the minds on another show. But it's a long-term approach, and you just want to have a game plan. The plan is, what's your asset allocation? You can age-base the risk. You could talk about a 30-year-old different than a 60-year-old, as you're talking about the back end. I was talking about the training wheels. Now now we're going from training wheels and a kid's bike to an 18-wheeler to a wheelchair. And I just made that up. Well, but as the life has transitioned, the risk has changed. The model's changed. The 80-20 down to 60-40. Now it's 50-50, and then it's 20-80. It's the other way, right? But do you understand the risks? I have episodes here. Bonds are defensive. They're not safe. I've been screaming that for the last 3 years when we were at 0 interest rates. Bonds are not safe as rates go up. And that's what happened, right? Last year, as you're referring to, that 40% safety net people thought they had of being in fixed income comes with risk. You don't understand. And what is it? It's interest rate risk. Whole other conversation, right? So go ahead.
Yeah.
Anyone? I got one more point to add into it, but to go into our 91 and 6. But go ahead.
I want to touch on a couple things real quick. I know time
should have made it 2
might
episodes,
be an issue, but that's okay. No worries. The first, getting back to trading wheels and moving up, right? So one thing most people don't understand is they may look at I'll just throw out a name, whatever, Ameritrade, who cares? They can certainly go on there and buy any sort of fund that they research and everything else. But there are a lot of other products in this business that, if you are of a certain age and maybe you want parameters, you want stops, right? There are things people don't realize, and when they talk to an advisor and right? Insurance and investments work hand in hand, right? So there's so many other things that can maybe fit into someone's portfolio that may not be your typical bond. It may not be your typical investment, but that's why having someone like us exposes you to all these different things that may fit your plan and let you sleep at night, right? So that's the first thing I want to say. The second thing is, at our firm, we don't have minimums, right? But what we will do is maybe refer somebody to an online account, or whatever the case may be. We'll always take a phone call. And if it is, like I said, I have many of my clients' kids. I have a lot, I should say kids. I mean, we're getting to that age, I guess, kids these days. I hate saying that. But I will direct them to something online because they're comfortable with it. Look, you get towards my age, I'm kind of at that cusp, right, where people aren't comfortable with that stuff, and some kids are. So I'll take that phone call. I'll show them how to do it, and I'll help them with their training wheel, so to speak. And then you know what? Eventually, they're going to get to a point where they're going to want guys like us who will help them and guide them, right? And listen, like I said, I'll always pick up the phone call. There's never a consultation fee, and I know that it's your thing too. So I think that's great. Like, we just want to pass on the knowledge, and if it results in business, that's awesome. So that's the other point I wanted to make. And the last point is bonds, right? Because you and I have always been in agreement with this. I have always said that bonds are not safe, right? Especially everyone's been pushed into this risk, so much more risk than they thought, right? Because the markets just pushed us that way. And it for the most part, it worked out, right? 2009 through 2019, let's say, one flat year, one bad year, and all those times, right? But people may not have realized how much risk is in the portfolio. One of our pieces of software is to kind of call that out and be like, well, did you know this? Your portfolio could lose 30% in a down market? Well, happened last year, right? And our software, for the most part, never kind of got out of its parameters, which was great. It proved that these things hold up. But when people talk about bonds, there are other products. I'm not going to get into products, but there are other products that can take the place of those bonds that maybe will give you the safety you're looking for. And you may not even know about it unless you talk to some guys like us. And, we'll lay out the pros and cons. It's always the client's decision. I'm just here to show you the menu and say, here's my opinion. Here are my thoughts. At the end of the day, you choose what you'd like to do. But so many people don't realize there's other things out there, and they certainly don't realize the risk, especially, everyone got taught a lesson last year. And
you stick around long enough.
What happens?
The question is, how many times people keep making the same mistake because they keep, you're 60 years old. This is not your first market correction, right?
Well, that's a behavioral bias. It's called overconfidence bias, right? It's well, I know this. Don't worry about it. I know that Amazon's going to grow forever, and I know it's going to be great. And for the most part, it can be. It's just, you need to, like you said, you need to know how much you're putting into one thing in that asset class and be comfortable with it, because if you're all in large cap growth space, you just need to know you're going to take the roller coaster ride, which is fine.
Again, we definitely should have made it a two-parter, but the key with the asset allocation component, we didn't do the last 2%, which is timing of the market. And so only 2% of the influence of your portfolio growth and consistency is trying to time the market. So let me just put that out. So 91% is where the money is, 6% is who's the money's with as far as particular managers and managing alpha, and then 2% is timing. But where I want to go, now I forgot what I said.
Are we missing 1%? Is that just our amazing personalities?
That might be our fee. But I don't know what that is, but that's always been the line. But no, I had something. Oh, rebalance. That's the key. The key here. No. Okay. I'm all over the place. The key component that you just said, or I wanted to tie the point in, is, and again, I use it in the terms of, if you're driving to a destination, which is your retirement, you have a certain amount of time, you have to drive a certain amount of hours a day, you have to go at a certain speed. Speed is your performance, your asset allocation. And then I used to put the analogy in there, think of it as your cruise control on your car. So when I get on the highway, I'm going to go 72 miles an hour in a 70 mile an hour zone. And I'm going to set the cruise control because I probably won't get bothered. I'll probably get past a little bit here and there, but I'm not going to go 80. I'm not looking for trouble. So if I plug in that if I go 72 miles an hour on a 1,000-mile journey, I'm going to arrive there within this range of time. And that's planning, right? So for my financial plan is I want to retire in 20 years. I'm going to save $1,000 a month. I'm going to make a 9% rate of return. And as long as I do that consistently and my money grows at 9%, I'm going to reach my destination on time, right? So that's the theory there. Well, as you just described, the last 10 years, we've had an abundance of growth on the equity side. We've had a flat fixed income bond market with relatively low inflation. And so if somebody went on a desert island for 10 years with no cell phones and no internet, their portfolio all of a sudden is skewed. If they were 60-40, they're like 80-20 now. Because they never did what? Absolutely. They never rebalanced, which is a big component here. Yep. And so think of rebalances as resume on your cruise control. So if a truck cuts me off and I got to hit the brakes, I'm going 50, I'm not going 72. I got to hit resume. I got to get back to my rate of speed. So if the markets went down for a year, I got to make up some of that lost time. I got to resume and get back to my risk levels to get my growth back. Conversely, I got to pass the truck. I'm going 85 to pass the truck. I'm going too fast. I got to hit resume and come back to my cruise control of 72. And so where Andrew's going to sit with you is not just build it, but you have to redistribute, you have to rebalance, you have to resume the risk tolerance, maybe every 6 months, at least once a year. So if 60-40 is now 70-30, you're not overheating. You're going to do what? You're going to take from the 70. You're going to bring it back to 60. The 30 is going to go up to 40. And again, I go through this whole dissertation with my audience when I do my seminars and show them the performance. Well, what are you doing? You're selling high and you're buying low. You bought underperforming assets in a down market and you used overperforming assets in an up market. Well, isn't that investing 101, Andrew? And there's no emotion to it.
Absolutely.
And so what that ultimately does is it educates our client that when the markets are in tumultuous times and you're recommending they buy more of a down performer, you pull back the chart, you show them the allocation, you remind them of the rebalance, and you've educated them to say, this is why we were going to buy now. This is why I raised cash. This is why I sold your Amazon when you didn't want to sell 5 shares. I was putting money aside because now you could buy Netflix at 50% off. And again, we're not giving advice here. Using names as example.
Right. But that ties into, once again, we started the conversation with risk, right? It ties into that also, because what happens with out of balance portfolios is generally your risk becomes out of balance. And that if you're looking at the well-being, not just of your portfolio, but of yourself, if you want to sleep at night and you want everything to be in place, well, that's necessary because you don't want to get out of alignment. And then that's, and it comes back into the planning thing. Is you have to have a strategy. You have to, you have to put it together. You have to act on it, and you have to make changes. And that's one of the things where you're acting on your plan, and there's no emotion whatsoever. You and I try to, our thing is to take the emotion out of it, right? Money's emotional. It always is. But our job is to try to pull that out of you and just make educated, logical decisions. Whereas most people are illogical with money.
Do you monitor your blood pressure and your pulse when you go see your doctor? They take your vital signs. Aren't we talking about the vital signs around your portfolio when it comes to asset allocation and risk? And
absolutely.
So again, folks, translate it any way you want. You have vital signs when it comes to your financial plan, your portfolio, your asset allocations. And that's what we're trying to do here, is to help mitigate risk. We've been talking with Andrew Mullane, certified financial planner, partner with Omnia Financial. And we've been talking about risk management, and we covered things on asset allocation and how to diversify and rebalance, and talked about the different components of risk that go out there: cash flow risk, interest rate risk, inflation risk. Okay. So, budget, health, like risk is all around us, and portfolio risk is true. It's understanding your goals, your objectives, your timelines. And most importantly, I think what we're trying to tell people is don't go with the loan. You don't need to go with a loan. The commission transaction, one-sided way of doing things is near dead. There's professionals like Andrew out there to help you win-win, fee-based, non-commission oriented in general, and just do what's right for you. And again, as a CFP, certified financial planning practitioner, he's got fiduciary responsibilities to do right for you. And you come in the door knowing that. That's the decree he's taken by being in the CFP organization. So, Andrew, how can people reach you if they want to discuss things further with you? If they like some takeaways from here, how can we get a hold of you?
Well, you can call me. My number 631-306-0853 is my office. My email is andrew@omniafinancial.com. That's OMNIA financial.com. You can look us up on our website, www.omniafinancial.com.
Put all that in the show notes. So again, folks, my name is Bruce Weinstein. I'm their host, Ask the Planman. Been speaking with Andrew Mullane. Love to hear from you. Please like, share. It's a long episode today. If you stuck to the end, thank you so much. We hope you got good value here. We try and give you the what's in it for you when you come on the show, and we hope to give you the so what's, some takeaways here. I think we give you lots of nuggets. Love to hear from you. Email me at bruce@asktheplanman.com. Check us out at planman.tv for our YouTube. We're everywhere on social media. Just look up Ask the Planman. Remember, folks, when you need some advice, always get it right. Come ask the Planman. And my new one, you don't know what you don't know, so you got to keep listening to the show. Until next time, Andrew, thanks so much for being with us, folks. Hope you got a lot out of today. Absolutely.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.